The modern global economy runs on one invisible force: debt. Every day, trillions of dollars move through global financial markets.
At the center of this system stands the United States.
Government bonds form the backbone of the global debt system.
Central banks influence the cost of borrowing across the entire economy.
Behind every transaction lies a promise to repay borrowed money.
The United States Treasury market anchors the global system of debt.
Interest rates set by central banks shape the cost of borrowing worldwide.
Most global debt is priced, traced, and settled using the US dollar. Credit expansion allows economies to grow faster than income alone.
After World War II, the United States emerged as the dominant economic power.
The Bretton Woods system placed the US dollar at the center of global finance.
As global trade expanded, financial markets began to grow rapidly.
Banks increased lending as credit became central to economic growth. Financial markets began distributing debt to investors around the world. Households gained access to mortgages that dramatically expanded home ownership.
Consumer credit allowed households to spend beyond immediate income.
Financial innovation created complex instruments built on layers of debt. Investors across the world increasingly purchased US government bonds. By the early 21st century, global debt had reached historic levels. Rising mortgage debt in the United States began to strain the financial system.
Major financial institutions faced enormous losses as mortgage securities collapsed.
In September 2008, Lehman Brothers filed for bankruptcy.
The Federal Reserve intervened to stabilize the collapsing financial system.
Central banks lowered interest rates to restore liquidity to global markets. The Federal Reserve began purchasing bonds to inject liquidity into financial markets.
Massive liquidity programs helped stabilize financial markets after the crisis.
Corporations issued large amounts of debt during years of low interest rates.
Investors worldwide continued buying US government debt as a safe asset. Total global debt continued rising across governments, corporations, and households. Debt expanded across governments, corporations, and households worldwide. Investors continued purchasing US Treasury bonds as a foundation of financial stability.
Credit growth allowed economies to expand beyond immediate income.
Mortgage lending remained one of the largest sources of household debt.
Economic growth increasingly depended on the continuous expansion of credit.
Low interest rates made borrowing cheaper for governments and corporations.
Companies issued record amounts of debt during years of cheap credit.
Mortgage lending remained a powerful driver of household borrowing. As borrowing increased, the financial system became more interconnected.
High levels of debt created vulnerabilities within the global economy.
Economists began warning about the long-term sustainability of rising debt.
Despite rising debt, U.S. Treasury bonds remain central to global markets. Investors moved capital across borders in search of stable returns.
Banks, investors, and governments became deeply linked through debt.
The financial system now depended heavily on the continuous flow of credit. Credit expansion allowed economies to grow faster than underlying income.
The financial system now depended heavily on the continuous flow of credit.
Of current entry, housing markets across many countries depended heavily on mortgage debt.
As leverage increased, financial markets became more sensitive to shocks.
The global economy had become deeply dependent on continuous borrowing. When interest rates rise, the cost of servicing debt increases sharply.
Highly leveraged companies become vulnerable when borrowing costs increase.
Households carrying large mortgages may struggle when economic conditions worsen.
Financial markets often react quickly when debt risks become visible.
Debt links banks, governments, and investors across the global economy.
Past crises revealed how quickly debt stress can spread through financial markets.
The collapse of Lehman Brothers demonstrated the fragility of leveraged finance.
Central banks responded by injecting massive liquidity into financial markets.
Extraordinary monetary policies helped stabilize the global financial system. Equinuli Pantecher.
Yet despite these lessons, global debt levels continued to rise.
Total global debt now exceeds the size of the entire world economy.
U.S. Treasury bonds remain the most widely held government debt in the world.
Major financial institutions allocate trillions of dollars across global markets. Debt connects governments, corporations, and investors within a single system. The structure of global finance remains deeply influenced by the United States.
The U.S. dollar remains the dominant currency in global finance.
Central banks influence liquidity across the entire financial system.
Large asset managers direct vast flows of capital worldwide.
Financial markets across continents now operate within a single network.
The global economy continues to operate on expanding layers of debt.
Yet the stability of this debt-driven system remains uncertain.
If borrowing costs rise, the pressure on the system could intensify.
The entire structure depends on confidence in future repayment.
For now, the United States remains the center of global financial power.
The world economy now moves forward on a machine built from debt.